think you start to sober up, and that's when valuations have a real problem. So I'm very nervous between now and year end for that reason.
So you said they're very nervous. You said incredibly nervous. What does that mean? If and when if you're right and we do see tapering announced in the next few months, what level of pullback do we see?
Well, think about it this way. It's all about field positioning and valuations, and that's a good starting point. So if you think about market cap of the entire stock market in the U.S. divided by GDP, that's sitting at 2.0 times. At the peak of the tech bubble, that was at 1.4. The 50-year average is 0.8. So my feeling is you can very easily get a 10 to 20% correction between now and year end. That starts with the Fed saying, yeah, we're going to taper. And, for the tech stocks in particular, it could be quite a bit worse than that because that's where you have the pockets of highest valuation. And so, and that really starts with, in my mind, that September the September payroll report, I think is going to be well over 1 million once you've got kids going back to school. My kids are going back to college in person, and you've got unemployment benefits, the extra ones expiring at the beginning of September. I think you're getting a massive number, and that's going to force the Fed, whether it likes it or not, to have to go ahead and start the tapering process.
Does it look like, Dan, then, that you're also very cautious on the consumer? It seems that demand is very strong right now, but you're talking about in your notes the credit card data starting to weaken. You think inflation will be more persistent than transitory. Southwest already remarking that demand is below guidance. So does that mean that when we should expect some warning signs from retailers when they report next week?
Well, I think that's the real risk, Courtney, and this is kind of, in some ways, the worst of all possible worlds, because right now you have this Goldilocks market where if growth is bad, then people are like, oh, that's great because the Fed will keep tapering, so the market goes up. And if growth is good, well, that's good too, because that means, earnings are going to be good. And I think what people are forgetting is if you go back to the last period of, really high inflation, which is the 70s, you had 50% earnings growth over 2 years between 1972 and 1974. The market went down 50% peak to trough because the multiple went from 20 times to 7. So even though you had 50% earnings growth, you got absolutely crushed as the market had to deal with this high inflation. And what you're dealing with right now, I think, is with the rise of this variant again, you have this strange combination of growth might be slowing, at least, what you're seeing from credit card data and Southwest and, Airbnb last night and, a variety of other companies. But you've also got rising costs, which is pushing up, cost